Hi everyone, and welcome back to the channel. You've been asking in the comments of video for more trading strategies. So today, I'll show you how to turn MACD into an effective gold trading strategy. MACD is short for Moving Average Convergence Divergence, and it's one of the world's most popular technical indicators, used by millions of traders to gauge market momentum and spot when trends are picking up or starting to lose momentum or running out of steam. Traders love it because it bundles trend direction and momentum into a single view. Yet, if you simply follow the textbook way of using MACD, you'll often get burned. One of the most common approaches is the zero-line crossover MACD. That's when the MACD flips from negative to positive, which is a buy, or from positive to negative, a sell. On paper, that sounds great, right? However, if you used the zero-line crossovers on gold recently, you would have sold here, and you would have bought here, both losing trades. That's the danger of trading MACD alone. In this video, I'm going to show you how to turn MACD into a reliable strategy. So make sure you keep watching to the end. But first, let's talk about what MACD really is and the three main ways that traders use it. So what is the MACD? MACD consists of three components: the MACD line, which is the difference between a faster momentum average and a slower trend average. Think of that like a speedometer, showing how quickly momentum is changing. Then there's the signal line, which is a smooth version of the MACD line. That's your trigger line that tells you when momentum shifts are meaningful. And we have the histogram, bars that represent the gap between those lines. Taller bars mean that momentum is building. Shrinking bars hint at a weakening push. The beauty of MACD is that it combines trend and momentum in one view. But that's also why many traders get it wrong. They focus on one line crossing the other or zero without any filter or context. There are three ways to trade MACD, and that can be confusing, but let's go over them. The first way to trade MACD is the signal line crossover. When MACD lines crosses up through the signal line, it means that momentum is turning positive, so look for a potential buy. When the MACD line crosses down through the signal line, that means the momentum is turning negative, so there's a potential sell. Traders love it because it gives an early heads up before price breakouts, but can also fake you out in strong trends. The main pitfall is that in sideways markets or low volume sessions, these crossovers can flip twice in a few bars, generating few false entries and frustrating your P&L. The next way to use MACD is the zero-line crossover. When MACD moves above the zero line, it means that the fast average has overtaken the slow average, so the overall trend is bullish. If it drops below zero line, it means the fast is moving below the slow, and the overall trend is turning bearish. Traders love that it confirms a full flip in trend direction, with fewer false signals than the signal line crossovers. But as you can see in my earlier examples, it can whip you out in choppy markets. And waiting for the zero line flips lock you into laggy signals. You're reacting to a completed shift rather than anticipating a move. The third way to use MACD is divergence. In a bullish divergence, what you want to see is price makes a new low and MACD makes a higher low. This is a sign that downside momentum could be fading and there's a possibility of an upside reversal. In a bearish divergence, price makes a new high, but MACD makes a lower high, indicating that upside momentum is weakening, so look for a possible reversal lower. Divergences help spot hidden shifts in supply and demand before price reacts, and especially powerful near key support and resistance levels. The problem, though, is that divergences can persist for weeks before price finally reacts, often leading to frustration without proper context or confirmation. Trading MACD alone fails because of choppy swings, late confirmation, or the lack of context. Gold often trades in tight ranges between major economic data or announcements. Zero-line crossovers can flip back and forth, triggering losing trades. And waiting for the MACD line to cross through the zero line means you're usually behind the move. Price has already made significant progress and you're chasing. Also, a zero-line flip tells you fast and slow averages are equal, but nothing about the overall trend strength, underlying volatility, or support and resistance levels. So how can you do it better? Instead, what I like to do is to combine the MACD with a 20-period EMA, which is the exponential moving average for short. Let me show you what this looks like on a chart. So the first thing you want to do is add the MACD onto your charts. So just go to indicators and type in MACD. MACD. And that will give you the moving average convergence divergence. So we've added that on the chart. And as I said, there's the MACD line, there's the zero line, the three components of MACD. Then you want to add the EMA, the exponential moving average. This is under technicals, moving average exponential. And I like to use the 20 EMA. And remember, this is a 15-minute chart in gold. So what we're looking for is we are looking for something that's very interesting. We want to basically look for the price, when you see the price close above the 20 EMA. If the MACD has been turned from negative to positive 5 bars or less ago, then, it's a signal to buy. Because what you're doing is you're basically buying a new change in momentum. So in this case over here, we have gold rising above the 20 EMA, but down here, the MACD is still negative. It's still red, so that's not a trade. Here's the next time that we see MACD close above the moving average. We check that it has turned positive within the last 5 bars. We go long and boom, very nice move higher with a stop over here. Now over here, we see that gold dropped below the moving average. And if you shorted, that would have been a bad idea. But we would not have done that because the MACD was above the signal line. It was green. So that means that it's not a valid trade and saves us from a bad trade. Another example here is over here. Now, normally, if you were trading just the signal line crossover, you probably would have sold here, which, sold here, which may not be a terrible idea. But this could be kind of frustrating where it moves against you and may cause you psychologically to think maybe I'm in the wrong trade. So instead, you want to make sure you trade when momentum and the EMA is in your direction. So that happens over here. So we see that it's dropped below the signal line. We see that MACD has moved from positive to negative within 3, 4, 5. This is the 6th candle. So that's okay. 6 is okay. So it drops below the EMA. And we just turn negative, and that's a much better place to enter the trade because it starts to move lower immediately, and maybe you would have taken some of your profits already. Even when it reached traces, it never went beyond that candle's high, and it definitely didn't go to your stop over here, which is a tighter stop than over here, and then boom, it starts to melt down. If you were trading the signal line and right here, you would have gone long here, which, probably wasn't a great idea. This, would have been a better trade, but we'll have to see how that plays out. Let's see another example. Here's a really nice example. Here is an example of basically gold dropping and closing below the moving average, and the histogram turns from positive to negative. And so that's a valid trade. And this becomes a nice move here with a stop at the swing high. So by adding the moving average filter, it definitely helps to get you into higher probability trades, and more importantly, trades that kind of work right away. That's really what we want to look for. Now, of course, you can combine this with just the zero line crossover and the moving average crossover. That gives you a double confirmation signal that this is a good trade. And here's another example. If you were just trading the flip here, you would have gotten from positive negative, you got short here and caught in a bad trade, which is a bad idea. So instead, you want to wait. This was not a good trade because the histogram is still negative. You want to wait for it to close above the moving average, and the histogram finally turns positive. And this is the best place to enter. When you enter this trade, and it starts moving right away. And that's why I really like. I usually have these additional indicators on, these additional filters in order to help get us into trades that work right away, because psychologically, once it starts moving against you, I know as a trader that we start to question our trades, we start to get nervous, we start to cast doubt, and we want to remove that as much as possible. And in order to remove that as much as possible, you want to add these filters, make sure you're getting into the momentum move as quickly as it happens. To recap, what you want to do is you want to add MACD and the 20 EMA to your 15-minute gold chart. You want to do a visual check to ensure the price closes above or below the EMA for your bias. Then you want to wait for the MACD line to cross the signal line in your bias direction. And if you want to look for divergence with the price, but in terms of mismanagement, make sure you place your stop loss below the recent swing high, swing low. Use a 1 to 2% risk per trade, and consider exiting either when the MACD flattens or reverses, or price closes back through the 20 EMA. The reason why this works is because it's noise reduction. The 20 MA keeps you out of choppy sideways actions. You're only trading in the direction of the prevailing momentum. That's very important. And by combining two filters, trend and momentum, you focus on only the highest probability setups. This simple addition filters out noise and aligns your trade entries with the dominant trend in gold. Now, some people may ask, can you use this for other instruments? Sure. Other time frames? Yes, but make sure you do your homework and check the charts first to see if there are positive results. If you want to learn more ways to turn technical indicators into trading strategies, type more strategies in the comments below and we'll keep going with strategies like this. Also, don't forget to join our free community. You'll get free trading courses, daily market updates, and so much more. The link is in the description below with a list of our favorite broker and prop firm partners. I'll see you all next time.